Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. Today we're going to take a look at silver. And the reason why we're going to take a look at silver is I actually took a look at silver last week and I actually had this forecast for the market. And specifically what I was looking for, we had waves A, B, C, D, and I was looking for a push up here in wave E to represent wave E, or the culmination of the pattern, and then a sizable move to the downside down to say about 25.50. That's what I was looking for. Well, as you can see here, what happened, silver actually rallied instead. So what happened? Well, bottom line, I was wrong. My outlook was wrong or incorrect with respect to silver. Now, one thing that's very important, I think by acknowledging that, it does not take away from the credibility or the validity of the wave principle whatsoever. In other words, the way we can look at this price chart from an analytical perspective, and one thing that's very important with respect to today's lesson is it's critically important for everyone to understand that analysis and trading are two totally separate endeavors. They're two totally separate skill sets. Now, with respect to the analytical portion of silver's price chart, once prices began moving above, or once they penetrated the extreme of 28.76, that's where you knew, or everyone should have known, that the pattern was no longer viable, that this pattern was evolving into something different. And this goes back to another lesson we've covered with respect to Elliott Wave Junctures, that if you're going to apply the wave principle in a real-time market environment, you must do so in a very flexible manner, not in a rigid manner. But going back to the price chart of silver, number one, my outlook was wrong. Everybody could have identified this on the break of the extreme of wave C here at 28.76. This is the analytical portion. Let's take now a look at the trading portion of the equation. Okay, now from a trading perspective, what we could have seen here as prices were moving up in what I proposed to be wave E of the pattern at 28.68, let's say, for example, you, rather than waiting for, say, a nice decisive confirming price action, which would have come with a move below, say, 27.75 or maybe even 27.50. Let's say we were aggressive with our position here and that we were anticipating the end of the wave E, and we were actually maybe taking a position here at 28.25 with a stop at 28.68. Well, that's fine. This was a nice encouraging move here to the downside, where we actually took out the lower boundary line of the corrective price channel. But what's concerning at this point is that the move did not follow through. So that would have been clue number one, that something was, as Sherlock Holmes would have said, something is afoot, something was wrong. But also, too, what you could have what we would have done at this juncture is, rather than having continuing to have a protective stop at, say, the extreme of wave C here at 28.76, it actually would have allowed us to lower that stop, or a protective stop, to 28.68, the culmination of the pattern, or the extreme of wave C. Once we saw this initial move down, subsequent advance in three waves, followed by another move to the downside, what we could have done then, rather than keeping our stop here at 28.68, we could have then lowered it to this point right there. Okay. Again, one of the three responsibilities, I believe, of a trader, whenever a position is taken, is number one, lessen risk, eliminate risk, and protect open profits. So whenever a position is taken, those are the three primary responsibilities. So whenever prices are trading down here at, say, the 28 mark, the protective stop could have been at this level right here. Then we see the advance and then the reversal. Again, what could have been done and should have been done is at that point, again, the stop even lowered even more. And certainly we don't want to see a break of the upper boundary line of the corrective price channel or the base channel at this point. So really, when prices began moving above this extreme here and the upper boundary line of that trend line, and also to this extreme here, really that 28.50 mark, you knew something was wrong with respect to the bearish outlook. So that's, again, the way you can look at a market from an analytical perspective, but also a trading perspective. And again, what's very, very important to understand from a trading perspective, one of the primary keys to successful trading is really risk management. Now, if we go back to this example here, and what I'm referring to, say, risk management, at this point, even if you had gotten into the short side, even at that level right here, with respect to where we were looking for the market to go, which was about 25.50, and even if you had kept the stop, the initial protective stop at the extreme of wave E at 28.68, the risk reward on this position was 1 to 3, which is perfectly acceptable. In fact, I would probably say that's a minimum objective, a risk reward ratio of 1 to 3. for any position. Preferably, yeah, you'll see 1 to 5 or maybe even more, where say you're risking $100 to make $500. In this instance here, you're risking, I believe, about 3,500 to make about 12 grand per contract basis. So number one, I think the risk for my money management or money management strategy of, say, our risk reward ratio of 1 to 3 certainly was met. And by dialing down to the smaller time frames and understanding the importance of 5-wave structures and 3-wave structures, it would have allowed you to manage risk quite well, even if you had gotten in prematurely without the confirming price action in this market. So what's going on with silver right now? Well, very simply, triangles can occur by themselves in the wave 4, wave B, or wave X wave positions. And again, we started with the idea in silver that this was a contracting triangle. I still believe it is a contracting triangle, but a contracting triangle B wave. Here's my wave A, B, C, D, E. This explains the contracting nature of the market we've seen the last few days. The move to the upside, which follows Jeffrey's law perfectly, Jeffrey's law being that whatever adversely affects the most people tends to be what happens. So a little bit more upside here, one more thrust higher to about 30.12. That's where wave C will equal the distance traveled in wave A. It'll also hit the upper boundary line of the corrective price channel. Things will be interesting maybe in about another 2 or 3 days. So I'm going to give this market a little bit more upside here to about $30 an ounce, and then at that point, well, that's when we can go from, say, the 100-minute time frame down to a 30 or 60-minute time frame and begin looking for those 5-wave declines, followed by those 3-wave advances. More importantly, we'll be looking for that confirming price action that we do indeed have the end of a larger completed corrective pattern that began at the May low. Thank you very much, and have a wonderful